talk about markets, quarterly numbers, way forward, and how 2024 could be different from 2023. And also the most common discussed question right now, what is the way forward for small and mid-cap stocks? And if this decade belongs to India, what will happen to capital market dominated businesses like Motilal Oswal Financial Services? A range of topics which we are looking at discussing with none other than Raamdeo Agrawal. I like to keep his introduction very simple because he needs no introduction. The reason why he needs no introduction is because he's one market investor who is an original thinker and has really managed to walk the talk in terms of following and is guiding his principles of investing. Raamdeo ji, so nice to have you on ET Now. Thank you for joining us. वो कहते हैं ना ऊपर वाला देता है छप्पर फाड़ के देता है तो quarter gone by has been bumper for you.
You said it. I think it is to do with the it is all time high in every aspect of whether it is operating, whether it is mark to market, assets under advisory, assets under AUM, you name it, everywhere it's a kind of 30, 40, 50% kind of growth. So it's a bumper result, I must say. But thing is that this is just about beginning of the large trend in the capital market. And it has become so acute that even banks are feeling the pinch of flight of deposits from the banks to the capital markets. So I think the experience of capital market of the larger masses is very good. I mean, if you see the return in last post-COVID particularly, from 7,500, 8,000 to almost like 3x. So I think the return is more like 20, even in the last 12 months, it is about 20%, 21% index level. If you look at mid and small, you know, it's like 35, 40%. So I think returns are very good. And that is enticing people to come to the market. Digital onboarding is there. In 5 minutes, you can open your account and start trading. So I think that has been a fundamental shift in the capital market outlook. And it has happened after, say, 75 years. In the sense that till 2020, there were only 30, 40 million demat accounts. That too with all kinds of duplication. So unique account must have not been more than 20 million. From there to go to 140 million in December. And now as we are talking, it must be more like 144 million. And unique account must be more like 80, 90 million. So I think it's a vertical growth in the capital market. And the network effect of good experience is pulling in more money from the existing guys. And of course, new guys are also coming. And it is going deeper into 5th, 6th tier of the markets. So I think, and this money is not going to go away, mind you. Unlike in 1990 when bull run happened, that time the money came and went in 2 years' time as the scam broke. But this time, this money is for good. In fact, the money flow will become bigger as we go forward. So, and I think it has so much of power of wealth effect that it can actually increase the GDP growth of the country. You might have seen this half year, that actually RBI estimate itself was wrong by 1%.
Yeah. On such a large base, 1% is a big miss.
And all the global economies, I mean, including ours, they are off by 1.5%. They were at 6.2, 6.4, and what turned out is 7.6. It is every quarter it is going to be like this. They will not be able to catch up because the wealth effect which is coming, it is going to spur the economy by at least a percentage or so, and the trickle down will happen. So conventional logic is already happening, capex is happening. So that is giving some kind of new energy to the economy. But the wealth effect coming from the stock market, that has yet another engine. So it's a twin engine kind of situation. One is the conventional engine and second is the wealth effect of the stock market. So my sense is we're in a very sweet spot.
Okay. Now, since we're talking about quarterly numbers, there is a big bump up in all your verticals and I'm looking at quarter on quarter. The quarter gone by, which is October to December, was also an unusually strong quarter for capital markets. Index itself gave a double-digit return.
Yeah.
That may not repeat itself going forward.
It will not. It would not. Generally, it would not because doing 10-12% kind of return in a quarter is very unlikely because then you are talking about 45-50% kind of return in a year. Yeah. That's very unlikely. But see, market is horizontally expanding. So capital market itself, say like December was extremely strong over October and November. September was very good. October was somewhat weaker. November picked up, but December was out of the charts. And January is even better than December. So what is happening is that momentum is picking up as we come closer to the budget time and then election time and then after that again budget time. So I think we have exciting calendar for the markets.
So you don't expect any slowdown per se to happen in terms of your capital market business?
Yes, capital market business will horizontally expand.
Okay.
Now, whether it grows at 10% quarter on quarter or 5% quarter on quarter, that depending on, even the markets are down, then people get stuck. See what people are doing in this momentum market, that they buy something today, it makes 20%, they will sell and buy something else. So that rotation is on. The moment market is down by 15-20%, then that machine stops, because whatever they have bought, that is all in loss. So the momentum of churning, that slows down. So right now, the momentum is positive, and if there is no break in the market, like even if it is 2-3% higher, say whatever was the December closing and March closing, it's a 4-5%, 3% higher, just about higher or same, I think momentum will continue.
And in terms of, you've let's say added about 40 lakh new accounts for the quarter gone by. The net number now stands at about 4 million. That's a very 4 crore actually.
No, you're talking about industry or us?
No, Motilal Oswal acquired 500,000 clients. The total active client base is now at 4 million. That's the number.
So I'm also not on top of that number, but yes, see, because what is happening is every month we're getting, this industry is getting 4 million customers. Last month was a record high, 4.2 million. Let's look at January. My sense is it will be matching. So if this level of influx is happening, right, it's bigger than Ayodhya, you know, the crowd in Ayodhya temple, this is bigger than that. And there the crowd passes through. They take darshan and go away. Here, the crowd comes to stay. So the cumulative crowd, participants, are too many.
But some would also argue and say that the pie is expanding. But for an intermediary or for a broking firm, brokerage rates are getting competitive.
Crashed, yeah.
SIPs are getting competitive.
Yeah.
AIs are now dominating what could be called as the earlier, wealth distribution business.
Yeah.
So while everybody is with you when you say that the large opportunity, we've just scratched the surface. But you will grow more, but you will make less money if margins come down.
See, my drop in the yield should be lower than the volume growth. So volume is growing at 40-50%. You see, my ADTO has gone up by some crazy 80-90%.
Yeah, I saw it.
But my revenue has not gone that much. So obviously, the yield per rupee of trade is lower because the mix is becoming more option oriented. So my yield, which was say maybe a paisa, would be 0.09 paisa types, So there is a drop in the yield. So actually, it has become very, very inexpensive. On a 90% growth of the ADTO, I have only 30% growth in the revenue. So what you're saying is right. The yield is dropping, but my expenditure is not growing at 30%. My expenditure might be growing at 20-25%. So there is actually a margin expansion at our level. And I don't see that changing. And we have a good control over the cost.
And given that this year, again, it could be a year which could be dominated by new listings, new IPOs, lot of PE exits. So I would imagine that the capital market business or the so-called merchant banking business will also be strong.
They are going to be king. The guys who have the good team. We have put a brand new team and we are doing all right now. But my sense is when there is so much of demand for paper, the supply has to come. And at elevated levels of valuation, clearly all the corporates, they will either do follow-on offering, the ones who are listed, the ones who are not listed, they'll get listed. So we'll have a very warm capital market throughout the year. Earlier it used to be window. 2 months it is on, then 2 months off, 4 months off. And mostly, all the iBanking companies were not doing well. Because it has become very, very short window of issuance. But now you see it is continuous.
Yeah. 3-4 issues every week is now common practice.
Week, yeah. In one day, I think it was 5 issues. I think a day will come, we'll have 10 issues in a day. So I think it's a wonderful time it is a terrific time to be an entrepreneur, hardworking, profitable entrepreneur. There is no dearth of equity. The first decade of this century was dominated by no equity, only debt. Now, the second and third will be dominated by too much of equity and less of the debt at a corporate level. So every company is taking pride in saying that we have delivered to the level of net cash. Steel companies are going net cash
now.
Pardon?
Real estate companies have net cash.
Real estate, your steel, cement, they are going net cash, which is crazy. You have to have, if you have ROC is about 10-12%, you'll never reach an ROE of 15-17% unless you lever up.
Now, you've followed a rule of 20% in 10 years is 10x, 20% for 20 years is 100x. But given that we've seen such exciting times in the capital market, can I say that the threshold now, at least for next 5 years, for your firm is actually not 20, it is between 25 and 30. That CAGR is an easy CAGR to assume.
See, it should be better than last 10 years. That much only I can say. Because putting a number is, because, see, capital markets can be parabolic.
We're talking about percentage growth here, not the profit growth.
I know,
percentage
I know.
growth. Here. Okay.
I can figure out, but see, basically, I can only say that whatever pace we have grown in the past 10 years, logically, because the market is horizontally expanding, number of customers are increasing, products are increasing, activity levels are very different. There is no reason why it will be not at least 4-5% higher. So we can do our numbers in last 10 years what we have done. We have done upwards of about 25%. This is a company which has done right from inception at about 25% top line, 25% bottom line. So I would think it should be little better.
Let's look at banks. They are always considered to be the proxy of what the economy is. For banks now, if I look at all banks, they are facing what could be called as a liability war. They're not getting deposits. Money is coming to capital markets. While we may feel happy when we see the numbers of a brokerage firm, but savings are not moving into banks.
But itna farak nahi hai. Nikunj, it's only marginal. I mean, if they are getting about 20 to 25 lakhs, of that 2-3 lakhs would have moved at best. They will get accretion, but they are used to free accretion. Like at 2%, 3%, people will dump the money in the savings bank account. That is not the situation now.
So you don't.
Now, you have to pay a little higher price. So you should be able, they should be able to pass on. The loan demand is very good from retail, particularly side. The real issue is that corporate side is not very strong. So basically, the pricing power, what they are saying is that pricing power is limited. So if your liability cost goes up, there is a NIM compression, and that will finally have impact on the ROTA. Despite volume growth and operating leverage, they will have tough time expanding the ROTA. So the market is apprehensive. The market has its own apprehension that might be ROTA might fall, and if ROTA across the industry falls, then you are, the whole valuation is based on some level of growth in profits, and price to book given is a lot more premium, so that they can raise money at 3.5 book. That may be difficult.
So there was a time 5 years ago where PSU banks were rescued by government. They were recapitalized. Bank of India, I think a quarter ago, raised money via QIP route. So from a government rescue to a QIP, things have changed for the banking sector per se.
Quite sure.
5 years from now, if you look at the banking sector, do you see the top pecking order, the 1, 2, 3, 4, 5, changing in a meaningful manner?
I don't think so.
Okay.
That will not change. I mean, in terms of size, see, when you're talking about, then we have to talk about the AUM.
Yeah.
Let's not talk about profits, because profits has different meanings. You can write back a lot of things which you are recovering and things like that. So, but I think the pecking order would not change meaningfully. Maybe ekat koi bank jo hai, matlab PSU banks like Canara Bank or PNB, who are erstwhile very large, they might come back to slightly higher reckoning, but the dynamism of the private sector, the flexibility they have in terms of talent attraction and the technology deployment, I think they have an edge over the PSU banks.
Everyone is confused about IT. We've seen these curves in the past. You've seen these curves in the past. Y2K, 2008, Enterprise, they've come out as winners. But now the street is divided. The numbers don't look very inspiring, but IT companies are saying that hum khade mein hum wapas aayenge. What is your view?
Yeah, see, the competitive advantage, they have global competitive advantage. There is no competition with Indian IT at an aggregate level. And now this AI thing has come, and I think US is on the cusp of rate, reversal, hopefully. That is what is most exciting part of it. That corporate activity will normalize, and they'll again get onto the building up for the future, and new technologies will be deployed, and larger contracts will come out for Indian companies, because ultimately even AI implementation will be done by Indians. So opportunity for IT implementation going forward, obviously it has to grow. It has to grow. But right now they are not growing. So the issue is that what do we do? I mean, I think the people dump the stocks and they use it almost like a hedge against buying other stocks. Then the results were not as bad as what they thought, and hence they had to cover it back. And that's why you see the kind of flurry of activities in that particular counter. I don't think the operations per se has much of a blowout quarter or some excitement which we don't know. I don't think, because they are very transparent companies, and there's not one company. All sorts of companies are there. And none of them are saying that we are, people are queuing up or anything like that. No.
The winners post-COVID essentially have been PSUs across
Yes,
the board.
yes.
I mean,
Big time.
they were known as ugly ducklings.
Yes.
Now they've become the center stage, from railways to defense. Is PSU more like a leader in this bull market, which will continue to go higher?
I mean, if government doesn't divest, yes, there might be some more stream, because the capex which is happening is clearly government last year they did about 10 lakh crores of capex, and that is still not done. The orders have just been given. It's not implemented fully. On top of it, you'll get another 12, 13 lakh crores in 24, 25 budgets. So I think there is problem of plenty in terms of these companies, what you call order book is concerned. How much they will execute, only time will tell. But I think the fundamental thing was that these companies were hated, like, as you said, it was hated, and they were all low single digit, not even single digit. They were low single digit, 3, 4, 5, 6 P multiples. And so when the whole market has gone to 23, 24 P multiple, you are at 4, 5. You're not so bad. You might be little inferior than, but there are enough bad private sector also. So I think there was a complete, disregard for the value underlying in these companies. I mean, they're monopolistic, very large. They can't be whisked away. And I think from there only it is coming. So it is a re-rating from bottom. That is, for 15 years, actually, if you see our wealth creation study in 2004-5, they used to have commanding heights in wealth creation,
yes.
45, 50%. It came to 0 in 22. Yeah. So from there it is rising. So I think there is a reversion to mean. So there is one portion which is reversion to mean, and other portion is whatever growth is there. So we should not, but these numbers don't come separately. So once the re-rating is done, reversion to mean has happened, say a company which is at 5P that has come to say 15P, that itself will give you 3x. So once that is done, then you have to see the merits of the company in terms of how the earnings are going to shape up and things like that.
Where is reversion to mean on upside becoming normalized? Where do you think the other way will happen? PSU is down, niche wale upar aa gaye. Reversion to mean can happen both ways.
Like,
so where in the market where valuations have really gone high,
yeah,
where they have to come back to mean levels, which means either time-wise correction or price-wise correction.
So I think time-wise correction is on. A lot of these high-price shares, they're not dialing up the market. So clearly, Asian Paints and Titan has done well because they have growth also. But there are a lot of these 80, 100, 120 P multiple companies, if they don't have aspirational growth rates, they are suffering in terms of their returns are sub-index levels.
If I look at some of your latest portfolios, you've added very different names. Manufacturing, energy. You're not just sticking to the 5-6 historical names. Yeah. Is that a conscious strategy?
Yeah, of course. There's a change of guards. My leadership was, I was much more, kind of buy and hold and sit through the good companies. But but it brings, so it gives you a bumper outperformance and it gives you a bumper underperformance. So it is good for private portfolio, not good for the public portfolio. So then we said, instead of maximum performance, either way, we will go for consistent performance. So there we have brought a very effective risk management process where downside is arrested. But when you arrest the downside, your upside is also somewhat compromised. But what we are trying to make sure is that 3 to 5% kind of outperformance across rather than 17%, 18% outperformance.
I'll take a liberty of asking you a direct question. Your son is in the business now. He's effectively managing the business.
Yes, not managing the business. He's managing a portfolio.
He's managing a portfolio. He's managing public money. I'm sure there are different thought every manager has. So what does Papa Raamdeo has to tell his son when they don't agree on a stock idea or they don't agree on an investment thesis?
No, I don't discuss anything. He doesn't, in fact, I would like to discuss, but he doesn't discuss anything with me. So there is no communication about portfolio. I don't know what he owns, what he buys, when does he buy, how much he buys, what is his style. No, I have no, I don't interact on his portfolio with him.
Okay, there's complete independent.
He doesn't take idea from me, I don't take idea from him. In any case, I don't invest. So I don't have to take idea from him, but he doesn't take any idea from me. And so we don't discuss. He discussed with the CIO, Pratik Agrawal, maybe with Naveen, and then colleagues, Niket and all. So it's complete hands off.
I've tracked your wealth creation studies, and I always urge our viewers that please read them. They're available on Motilal Oswal website, and they're for free. Free and available. They're two things which Indians always want, and wealth creation studies are there. They're free and they're available. So I'm going to quote one of my most fondest recall of a wealth creation study. You should have courage to buy, vision to see, courage to buy, and patience to hold. Apply that theorem for us in the market right now.
Yeah, so I think the patience is being tested because we have not seen such rich valuation for a very long time, but we have also not seen economic resurgence of India and liquidity participation. The retail participation, both are coming together. See, when Harsha Mehta bull run happened in 1990, it was only liquidity without fundamentals. This time there is a strong fundamentals. Your forex reserve is $600 billion plus. Your fastest growing economy in the world. Inflation is under control. You have your corporate earnings growing at 15-20%. So everything is right on the fundamental side. And then on top of it, you get the added advantage of massive liquidity influx. 5 million customers, 4 million customers a month is almost at least 1,000 crores per day. And predictable. See, it's not that off and on. So, so the combination is lethal, fundamental and technical both. So it is uncharted, I'm telling you. None of the charts will be right, believe me. On a good stock and on the market predictions. Because the force behind a market and force behind a stock is of a different order altogether, 5x, 10x. Right?
So is this like the 1980s, what happened in, let's say, Japan, and followed by what happened in 1990s in US?
I have not lived. I have seen only some stories. I have not lived because we were not there in the market at that time. But I have lived the craziest bull market of India, that was 90 to 92.
90 to 92.
90 to 92, Harsha Mehta bull
Yes,
run.
yes, yes.
So from 700, stock market went to 4,200 in 19 months.
Yes.
Okay, there was no SEBI. I think, unfortunately, we didn't have SEBI.
They came
so
after
they couldn't control. And in fact, the arrival of SEBI was because of this scam. So clearly now we have SEBI, we have RBI, we have digital traction. So I think the force multiplier this time is much bigger. Okay, but since we have surveillance and proactive risk management by SEBI and dematted kind of a situation, no physical shares. That time physical shares, so you could do BR, this, that. So that is not there. So you have everything dematerialized. So I think it's a very smooth system. Margin system is very effective. So my sense is the actual impact is much bigger. The liquidity as well as fundamental change is massive. So I think we'll have wonderful 4, 5 years, 10 years. In any case, we are getting new mandate for the political continuity. So at least 5 years out, it looks to be pretty good, so long as we don't become parabolic. If my index performance is 15%, 17%, 0%, 0 to, or even minus 10 to plus 20, 25, we are fine. The moment it goes to 45, 50%, then you have a problem.
So if I paraphrase a line which a common friend Rakesh Jhunjhunwala used to always say,
What is that?
The mother of the bull market lies ahead of us. I would be right in saying that.
Yeah, I think this is what is going. I mean, see, we don't know how big this is going to be, and after that, can it be bigger? I think in India as a growth economy and growth stock market and participation. See, the culture of stock market is deep. I mean, 120, 130 years, 40 years. So, I mean, losing and gaining is accepted without any problem. So, and say options have been taken as a kind of a acceptable way of participating in the market. So the culture and so I think the rise of the country from 4 trillion to 8 trillion and 8 trillion to 16 trillion, these two phases, which is almost from 4 to 16, 4 to 8 itself, let's talk about 4 to 8, that itself is going to happen by 2031, 32. So, and then let me talk about expansion of the capital market. See, my market cap to GDP is about 1.25. So we are at $4.5 trillion kind of market cap.
4 trillion plus.
My GDP is still at 3.2 or something like that, 3.7 or something. My GDP is expanding at best at 9 to 10%, even in dollar terms. But my market cap is expanding at the rate of 25%. In 3 years flat, I'll be as big as China.
So which means that let's say we go from 4 trillion to 8 trillion in the real economy. It could happen in 2030, it could happen in 2031, right?
8, 9 years you must take.
8, 9 years.
Yeah.
If I use that same force of multiplier, which is that 1.2 into 8, that means we are looking at the capital market directly, indirectly, becoming at least $10 billion in 7 to 8 years.
No. You're confusing me. See, GDP will double it by 2032.
Yeah.
From 4 to 8.
That's about 8 years.
8 years. But my market cap will double in 3 years flat.
Yes, because it's at 1.25.
Yeah, at 1.25 because
1.25.
GDP is growing at 9%, 10% dollar terms, 9.5%.
Yes.
That's their projection, and that's what we have done in last 25 years. But by market cap, see, index grows by 12, 13%, 15%. But the new listings, they expand the base. So the total market is growing at the rate of 25%. That's the real wealth growth.
But Buffett has always said he's used this traditional GDP, market cap and GDP
That's a
indicator.
Buffett ratio part.
That's a Buffett rate. By that yardstick, we are already expensive.
See, don't say expensive. We are higher than historical standards.
Okay.
But the world is higher than historical standards. Today, US is trading at 2 times.
Yes.
I mean, I read a book where they say that potentially you could be as high as the world can be as high as 5 times GDP. It can support that if the right level of securitization happens. And that's why I say that all the unlisted large companies, they should think about getting listed.
So everybody looks up to you for advice. My first couple of last questions, then we'll wrap after that. One very basic question is, what should one do with small and mid cap? Is it time to book just 15-20% profit, move back into large cap? Is that a very basic standard and a good advice?
Yeah, see, small and mid is not 100, 200 companies. There are thousands of companies.
Okay.
So where things have, the stocks where you've gone berserk, I mean, say 50p, 60p, it doesn't make sense. I mean, the historical P multiple is at 20. Median P multiple for, I mean, in screener or something, you can get the median P. So if median P is average is about, say, 21, 22, and it is trading at 45, 50, you must book profit. And if you are big lover of a small cap, you must go to the reasonably priced new discoveries within them itself. Because it's not